In this week's lecture, we want to look at a very fascinating process for measuring economic growth in our economy. And that process is built around the concept called GDP, which stands for Gross Domestic Product. These issues are discussed in Chapter 5 in the textbook. And so we want to walk through the process that we use, that's used in the United States for determining whether or not our economy is growing, which is one of our goals, or if the economy is shrinking. When the economy shrinks, it's said to be experiencing recessionary conditions. Right, so GDP is how we determine whether the U.S. economy is growing or shrinking. Now, clearly, there are some benefits associated with a growing economy. Some of the obvious ones: when the economy grows, we have more goods and services. And in fact, the GDP process focuses on whether there are more goods and services, because that's how we're going to measure growth. If there's larger quantities of output, goods and services, that is the focus of the GDP process. Now, in addition to goods and services being produced, when more stuff is being produced, it's going to translate into more income. So a growing economy will generate more income. And when more stuff is produced, more workers are needed, and so more jobs are being created. So there are some very nice, wonderful benefits associated with growth, and we're very desirous of having more goods and services, more income, and higher levels of employment. And there are also some negative implications as well. For example, when more goods and services are produced, it increases the possibility of more pollution, which can have negative environmental impacts. And of course, if the economy grows too fast, that causes inflationary concerns, which can undermine the good things associated with growth. Now, we must be clear in terms of what constitutes healthy growth, because if our economy grows too fast, it causes inflation. So it must mean that there is some rate of growth that's considered healthy. And the rate of growth that's considered healthy is where something called real GDP, which we'll learn about in this chapter, but real GDP grows by 3 to 4% per year. So if the economy is growing at that rate, if it's cranking out new goods and services at a rate of 3 to 4% per year, that's considered healthy, right? So that's our standard for healthy economic growth. All right. Now, in trying to measure growth, that's a rather complicated undertaking, because you have, our economy is very massive, and it has a lot of interesting facets and dimensions to it. And trying to have a systematic way of measuring how it's growing or shrinking is quite a daunting task. But there's a framework in place for assessing growth, and it's called the National Income Accounting Framework. Accounting in the sense that you are trying to balance two things, right? This process was developed originally by a great economist. His name was Simon Kuznets. He was a professor of economics at Harvard, and he developed this very impressive process. Now, the way the process works is you want to you're trying to identify how the quantities of goods and services are changing. And of course, goods and services are bought and sold in markets. And so the centerpiece of this framework is you start by looking at markets where you have the economic transactions occurring. So economic transactions occur in markets. And we know that a transaction is an interaction between a consumer and a producer. And so consumers, when they engage in transactions, they experience expenditures. Like if I go to the store and I need to buy, a box of cereal, I have to spend money to acquire that good, right? So from a consumer's perspective, a transaction represents an expenditure. From the seller's perspective, the transaction represents a source of income. So if I go to a store, I spend, say, $5 to get the cereal, and the retailer, the seller, gets the $5. So they receive $5 in income. So in this process, in this framework, if you can identify all the expenditures in the economy and sum those up, that will give you a sense of how the economy is behaving. Because if you can identify the expenditures and expenditures equal income, then you can also identify the income. And so if you sum up all the expenditures and see the expenditures are growing, it simultaneously means the income is growing. As we saw earlier, more income is a sign that the economy is growing. Right? So the basic premise is, if I know all the expenditures, I will know the income. And as the income and expenditures change, it gives me clues about growth. Now, there are two approaches we could use for doing this inquiry on growth. One approach is called the expenditure approach, where you go through and you sum up all the expenditures in the economy, and the other approach is called the income approach, where you go through and sum up all the sources of income. And as is demonstrated in the textbook, both approaches end up at the same point, because expenditures equal income. Now, the approach I'm going to use here, because it's a little less cumbersome, is I'm going to sum up the expenditures. So I'm going to take what are called consumption expenditures, which are expenditures by households. So consumption expenditures are expenditures by households, expenditures on durable goods, non-durable goods, and services. Sum up all those expenditures. Then I'm going to add to it investment expenditures. Now here, investment means expenditures by businesses, and specifically you're focusing on expenditures such as expenditures on capital goods, inventories, and also some business construction related activity, like residential construction. So investment here has specific meanings. Expenditures by businesses on capital goods, inventories, and residential construction. You look at expenditures by government, federal, state, and local. Look at all expenditures by the public sector collectively. And you look at international expenditures, exports and imports. And so summing up all those expenditures, once you have that total, you will then know the total for all the income. So we're going to focus on the expenditure side. Alternatively, I could have summed all the wages, all the rental income, all the interest income, all the business profits, and summed up all those components, and it would equal the expenditures as well. We're going to focus on the expenditure side. Okay. Now, when you are looking at, as I just mentioned, the expenditures and the income approaches, as those expenditures change, as income changes, it will tell us whether the economy is growing or shrinking. And the organization that does this, that has the responsibility of doing this assessment, is the Bureau of Economic Analysis. They are a subgroup within the Department of Commerce, and one of their charges is to measure economic growth or shrinkage in our economy. And they do this each quarter. So every 3 months they check to make sure that our economy is growing healthy. Or if it's not growing healthy, they will try and determine why it's not growing healthy, and then that triggers a policy response. So from our discussion thus far, we can come up with an initial definition of GDP. When we were defining GDP, you could take consumption expenditures plus investment expenditures I, plus government expenditures G, plus net exports, where net exports is exports minus imports. So one way of defining GDP is simply the sum of all the expenditures. Okay. Now when it comes to GDP, there are two ways of measuring it. So there are two types. One type of GDP is known as nominal GDP. And so nominal GDP is where you estimate GDP, but you're going to use current prices. Now, let's step back for a second. Again, we're using the expenditure approach, and expenditures look at, for example, take the case of households. If I go to a store and I use my cereal example again, I buy a box of cereal. That cereal has a price, right? And so how much I pay for that cereal will be dependent on the price for the product. And so that price is going to influence the size of my expenditure. So when you estimate GDP using current prices, like cereal is $5, that price is then multiplied times the number of boxes of cereal I buy. So if I buy one box of cereal, the price of $5 times the quantity of one box will give me a total expenditure of $5. So when you estimate nominal GDP, you just take the $5 that was spent, multiply it times the quantities of the good that was purchased, and that would give you your nominal estimate. Now, the danger with nominal GDP is that because you're using current prices, you haven't corrected for the effects of inflation. So I'm just taking my $5 price and use that as the basis for determining the expenditure, but I haven't accounted for the fact that prices fluctuate over time. So nominal GDP, because it's focusing on the current expenditure, the current period, it hasn't accounted for how prices have moved over time, and so it tends to ignore the effects of inflation. And so because of that, we cannot use nominal GDP to assess growth, because it is possible for GDP to get bigger for several reasons. One, GDP could get bigger because prices go up and quantities stay the same, and that type of increase is kind of illusionary because GDP focuses on the quantities. And so if GDP is getting bigger because prices are going up, that's really not growth, it's really just inflation. It's also possible for GDP to get bigger because the quantities increase and the prices stay the same. Now, if GDP is bigger for that reason, then that's perfect, because the quantities are increasing, which is a sign of growth. Prices are stable, which is the goal we have in terms of not having to deal with inflation. So GDP can increase for several reasons, some of which are kind of erroneous. And so nominal GDP doesn't make the distinction. It doesn't control or correct for inflation. And so as a result, we can't use nominal GDP to assess growth. So when it comes to measuring economic growth, the way we do that is we focus on real GDP, something called real GDP. So real GDP is where you estimate GDP using what are called constant prices, and we'll look at how that is determined. So you in effect make prices constant, and by making prices constant, you have accounted for inflationary influences. So real GDP corrects for inflation, nominal GDP does not, and so as a result, we use real GDP for assessing growth. And we'll look at how to distinguish between the two so it becomes clear. But the point to recognize is that when we make any assessments of growth, it's based on real GDP. All right. Let's look at an example, some data to make the distinction. I have some data here that I'm using from the Bureau of Economic Analysis. This is something they released in April of 2011, and it gives me the nominal GDP and the real GDP for select years. I just pulled some select years from this data source, and the years I focused on was 1970, 2005, and 2010. Right? And they give me some nominal GDP numbers and they give me real GDP numbers for these respective years, so I can use them to further illustrate the difference between nominal and real GDP. Alright, so for example, let's take the year 1970. 1970, they have a nominal GDP number of 1,038. These numbers are in terms of billion, so it would be 1,038,000,000,000. That was the value of the expenditures in 1970. And so on a nominal basis, you take the current prices. So you take the prices for 1970, those are the current prices, and you multiply them times the quantities of goods and services that were produced in 1970. So taking current prices times current quantities, it gives us nominal GDP. Now for real GDP for 1970, notice the estimate is 4,270,000,000,000. And the way they get that is they take 2005 prices and multiply them times 1970 quantities. Now, what is going on here? What's going on here is in order to correct for inflation, you have to have a set of prices that you're going to use as your standard, and so you're going to target a certain group of prices, and those prices will serve as the standard prices by which you will compare each of these years. And in doing that, you have to choose what's called a base year. And so for purposes of this exhibit, the Bureau of Economic Analysis chose 2005 as their base year. And by choosing 2005 as their base year, they take the prices for 2005 and replace every year's prices with 2005 prices. And by replacing every year's prices with 2005 prices, it makes prices constant. So real GDP was based on 2005 prices in 1970, 2005 prices in 2005, 2005 prices in 2010. So prices are constant over this time period. And once you made prices constant, any change in the GDP numbers has to be due to changes in quantity. Again, GDP is trying to measure how quantities change, and so real GDP allows that because you correct it for price movement. All right, so if you notice here for the base year, which is this, you take the price for the base year and replace every year's prices with the base year prices. For 2005, notice that the nominal GDP and the real GDP are the same. And it makes sense because if you replace every year's prices with the base year prices, then for your base year, you simply replace its own prices with its price with its own prices. And so for the base year, nominal GDP and real GDP will be the same. For years prior to the base, like 1970, real GDP is typically going to be larger than nominal. Because if I replace 1970 prices with higher 2005 prices, my real GDP number is going to get bigger. So for years prior to the base, real GDP is larger than nominal. Now for years after the base, like 2010, the opposite should be true. In 2010, prices were lower than they were in 2005. And so if I replace higher 2010 prices with lower 2005 prices, the real GDP estimate should be lower. So in general, for years after the base, real GDP will be less than nominal. Right? So for nominal GDP, you take the current prices for the period you're studying, apply those prices times the quantities, and that will give you the nominal GDP estimate. But for nominal, you're not correcting for inflation because over time prices are going up. Prices in 2005 were dramatically different than they were in 2007. Prices in 2010 were different than they were in 2005. So nominal doesn't correct for inflation. So nominal will give you a false sense of growth. Real GDP, on the other hand, you make prices constant. You use 2005 prices in every year's estimate. And so any change in the real GDP numbers will strictly be due to changes in quantity. So real GDP corrects for inflation, and so it's a better way of measuring growth. It's the real way of measuring growth. Okay. All right. To explore this a little further, the way you adjust the prices for each year is you have to develop something called a GDP deflator. And the GDP deflator is simply a price index. And the objective of this index is to make prices mathematically the same as they are for the base period. And to illustrate this, I have the same nominal GDP numbers from the previous slide. I have the same real GDP numbers from the previous slide. If I take the nominal GDP numbers and the real GDP numbers, I can start to note interesting differences. For example, notice that for 1970 the real GDP was 4,720,000,000,000, whereas nominal was 1,038,000,000,000. That means that real GDP is about 4 times as large as nominal, or the flip of that would be prices during the base period were about, for example, think of it this way. During the base period, which was 2005, if something cost $1 in 2005, in 1970 that product would cost about 24 cents. So what the index is doing is recognizing that prices in 1970 were lower than they were during the base. And it's a way of bringing prices up to the base year level. So the way you interpret the way you calculate the index, you can take nominal GDP and divide it by real GDP, and that will give you the index. And that index is telling you how prices for that period, how much they differ from the base. So point, a GDP deflator for 1970 says something that cost $1 in 2005 will cost you about 24 cents in 1970. So the deflator is telling us how much prices for the current year, how they differ from the base. And then you can use the index to bring the prices up or down to the base year level. For 2010, you have an index value here of 1.1066, and you calculate that by taking nominal GDP divided by real GDP, and it gives you an index value of this amount. And this index value is saying that what cost $1 in 2005 would cost you almost $1.11 in 2010. So it's telling us how prices differ in 2010 from 2005. And so you can then adjust the nominal GDP numbers to account for this difference in prices. So the indexes, the GDP deflator indexes, are ways of correcting the prices for each year to make them the same as the prices for the base. So in effect, for 1970, because prices were basically a quarter of what they were during the base, you're going to need to inflate 1970 prices to make them equivalent to the base. For 2010, where prices were almost 11% higher than the base, then you would need to deflate the prices for 2010 to make them the same as the base. And once you make them the same as the base, then you correct it for inflation, and any change in the GDP numbers, any change in the real GDP numbers, will be reflective of strictly changes in production or changes in quantities. Alright, so from the table here, you can see how to calculate real GDP. Real GDP should be take nominal GDP and divide it by the deflator. So if I take the nominal GDP numbers for 1970 divided by the index, it's going to inflate those prices up, or the GDP estimate up to the base year level. So this 4,270,000,000,000 would be looking at GDP in 1970 but using 2005 prices. So we bring prices for 1970 up to the base year level. For your base, of course, because it's your standard, nominal GDP and real GDP will be the same. And for 2010, because prices are higher in 2010 than they are during the base period, you would need to deflate the prices. So you deflate nominal GDP down to the real GDP level, basically reducing it by about 11%, and then you've made prices for these periods all the same. And so if price is the same for your base period as the base period, then any change in the GDP numbers would be strictly changes in quantity, which is what GDP is trying to track. So there are some other ways here of calculating the different components. Nominal GDP, you could take the GDP deflator and multiply it times real GDP. Or to calculate the GDP deflator, you could take nominal GDP and divide it by real GDP, as we talked about earlier. But the objective of the deflator simply is a mechanism to help us identify how much prices for each year differ from the base. And then once you know how much they differ, then you can inflate the prices for that year if necessary up to the base year level, or you can deflate them back down to the base year level. So it's called deflator because most times we find prices are going up, and so you have to bring them back down, deflate prices back down to the base year level. And once you've corrected for difference in price, any change in GDP numbers will be due strictly to changes in quantity, which is what the GDP process is trying to track. Okay. All right. A second definition of GDP is now relevant. We can define GDP as the final market value of all newly produced goods and services during some time period. Market value is simply where you take the price of something times the quantity of something. For example, if I want to sell my house, the final market value will be determined once I find a buyer that's willing to pay the price I'm looking for. So there'd be a price and a quantity. The price would be the agreed upon sale price, and the quantity would be my one house. So market value, final market value occurs when buyer and a seller, or buyers and sellers agree. So final market value is really code for expenditure, because the person that buys my house will have to spend a certain amount of money to acquire my house. And once that transaction occurs, then that creates the final market value at that moment. Another aspect of this definition that's important is GDP focuses on newly produced goods, only new stuff. So when you're trying to measure growth, growth is additions, is new additions. And so the GDP process, as it's tracking quantities of goods and services, is trying to identify new quantities, new stuff. So, so GDP process is very adamant about excluding old goods and services. So, like for example, if a automobile was produced in 2005, that year it was produced, 2005, it would be included in the 2005 estimate of GDP. And you wouldn't want to include that automobile in any subsequent estimate of GDP because it would overstate growth. So by focusing on newly produced goods and services, we avoid making the mistake called multiple counting. And multiple counting would tend to result in an overstatement of growth because you're mixing with the newly produced goods and services old goods and services that have already been produced and already been captured in a previous period's GDP estimate. So you want to avoid, as the Bureau of Economic Analysis works very hard to do, you want to avoid counting things more than once in the GDP process. The other aspect of that definition is that GDP focuses on different time periods. The Bureau of Economic Analysis, as I mentioned earlier, will do a quarterly assessment. Every 3 months they check to see if the economy is growing healthy, if it's producing 3 to 4% more new goods and services. And they also do kind of like an annual assessment where they, combine all the quarters to get kind of a sense of how the economy behaved on a yearly basis. So they come up with estimates every quarter, and they also do an annual assessment of how the economy is doing in terms of growth. All right, now in the GDP process, the bulk of the expenditures come from households consumption. So consumption is by far the biggest component in the GDP equation. And so because of its relatively large size, it tends to get a lot of the attention, and justifiably so. But the investment expenditures, those expenditures by businesses, are, in my assessment, equally crucial. Because if businesses aren't buying capital goods, if they aren't adjusting their inventories, then it's going to dampen the amount of goods and services that households will have access to purchase. So I want to take a closer look at investment, just to give investment some respect that it sometimes loses because it gets so overshadowed by the big household sector consumption expenditures. Alright, so take a closer look at investment. You need to be comfortable with some terms. One term that's important here is something called gross investment. And gross investment looks at the new expenditures by businesses on capital goods and inventories. So gross investment captures the new expenditures. So during a period, if a business buys a new fleet of trucks, those expenditures will be considered gross investment. Another term is the consumption of fixed capital, CFC. And the consumption of fixed capital measures kind of the amount of capital goods that no longer become usable in the production process, because machines wear out over time. With continuous use, they start to break down, they start to become antiquated, and so consumption of fixed capital is measuring how capital goods, the rate at which capital goods are wearing out. It's kind of like the accounting term of depreciation. So it's measuring how the capital goods are diminishing due to their use. Net investment is simply going to be the difference between gross investment and the consumption of fixed capital. It's the difference between the new stuff that's being added, the new capital goods, and the old capital goods that are wearing out. So we call it net investment. Now, any inquiry of investment has to be built around this thing called the capital stock. And the capital stock is just the collection of all capital goods in the economy. So it's going to include all computers, all office buildings, all delivery trucks, all tools, all devices, all those things that are used to produce other goods and services. So the capital stock is think of it as the collective productive infrastructure for the economy. All office buildings, all computers, all hammers, all delivery trucks, all those things collectively represent the capital stock. Alright? Now when you look at the interplay between these concepts, think of the capital stock as this box. And when you have gross investment expenditures are additions to the capital stock. So when businesses buy new equipment, once it's brought online, it becomes a part of the capital stock. Right? Now the capital stock tends to shrink over time as machines in the capital stock wear out. And so the CFC is measuring how the capital stock is shrinking. So gross investments are addition to the capital stock. The CFC represents subtractions from the capital stock. And so if net investment is gross investment minus the CFC, we can see how the capital stock can change potentially in response to this interplay. For example, if gross investment is greater than the CFC, then you're adding more new stuff to the capital stock than stuff that's wearing out. And so when that is true, net investment is positive. So net investment is positive when gross investment is greater than the CFC. And what's going to be the effect is that the capital stock will get bigger. And as the capital stock gets bigger, we have more machines, more tools at our disposal, and so our prospects for economic growth will go up. So an expanding capital stock means that our economy has an infrastructure that's capable of producing more goods and services, and of course that would be a plus for economic growth purposes. Now if the opposite is true, if the CFC during some period is larger than gross investment, if more machines are wearing out faster than we're adding new equipment, then the capital stock is going to shrink. And when the capital stock shrinks, that's going to dampen our prospects for economic growth. A very interesting case is, what if the new machines we're adding in terms of numerical value are exactly equal to the rate at which machines are wearing out? For example, if in society the capital stock is increased through gross investment by $2 billion, so $2 billion worth of new equipment is added to the capital stock. But then we measure and find that $2 billion worth of equipment in the capital stock is actually deteriorated due to the continuous use. So the CFC is also $2 billion. So we add $2 billion worth of new equipment, but $2 billion of equipment, existing equipment, has been detected as wearing out. In that case, the capital stock would stay the same size. And one would be inclined to conclude, well, if the capital stock is the same size, our prospects for economic growth won't change. But there's something you got to be aware of. This new equipment that's being added is going to reflect the latest technology. And that improved technology should translate into more productivity, more efficiency. So we're replacing old equipment with new equipment that's more technologically advanced. Even though the capital stock stayed the same, our prospects for economic growth may actually increase. So if the capital stock stayed the same and you're adding new equipment that has the same price tag as old equipment that's worn out, that new equipment is going to be more productive. And so even though the capital stock stayed the same, our prospects for economic growth may increase due to this technological improvement. So you got to really be careful in that last case, because it tends to ignore the effects of technology, whereas technology, of course, allows us to do more with less. All right. In the chapter, there is some discussion of different measures of income. Again, I've had such a bias thus far towards expenditures, and you can actually do a lot of interesting work on the income side, on the income approach as well. For example, if you take, as we saw in the earlier slide, if you take all of the expenditures, it gives you GDP. So all expenditures represent GDP. Now, if all expenditures represent GDP, then, and the sum of the expenditures equals the income, I can calculate a measure of income called gross domestic income in an equivalent way, because gross domestic income is capturing all the income. So GDP captures all the expenditures. GDI, gross domestic income, captures all income sources. So a clever way of calculating GDI would be to take the equation we use for GDP, C plus IG plus G plus X minus M. I'm using IG, or gross investment, now, since we've learned that gross investment represents new expenditures. So GDI is the same as GDP, so I would just use the equation for GDP, and that would give me a quick way of measuring GDI. Now there are 5 measures you want to look at. GDI, which is the sum of all income, and then there's a measure called net domestic income, NDI. There's another measure of income called national income, NI, and there's a measure of income called personal income, PI. And then there's this the purest measure of income is called disposable income, and we use the symbol DI for that. And so how you would calculate each one is just a question of refinement. GDI, as I mentioned, we can take the equation for GDP and calculate GDI. To calculate NDI, you simply subtract from the GDI estimate the wear and tear on the capital stock, the CFC component, consumption of fixed capital. So net domestic income is GDI minus the CFC. National income would be where you take NDI, which you just calculated, and subtract from it a very strange estimate called taxes on production and imports, or TPI. And taxes on production and imports is just a technical adjustment you make to account for transactions that involve more than two parties. And so, because if you remember the national income accounting framework, you have an expenditure side, you have an income side. There are some transactions that involve more than two parties, and because of their more than two party focus, those transactions are excluded, and they're called taxes on production and imports. To calculate personal income, you take national income, which you just determined, and you subtract from it Social Security contributions, undistributed corporate profits, and corporate taxes. So those three things you subtract from national income. And then you're going to add back to it transfer payments, TP, plus net interest. So to calculate personal income, you subtract three things: Social Security, undistributed corporate profits, corporate taxes, and you add back two things: transfer payments and net interest. And that gives us personal income. The last measure of income, which is the one that's going to be useful later in the course, very useful, is disposable income. And you take your personal income, which you just calculated after going through that convoluted process, take personal income and subtract from it personal income taxes, PIT. And by doing that, it will give you these different measures. Now, we demonstrated this in class. There are examples in the textbook. So it's just a question of knowing what to plug, how to add or subtract, and then you just refine each measure of income as you go to the subsequent one. Okay. All right. Last couple of things I want to mention involving GDP. In the textbook, there is discussion of the circular flow model, and you get a sense of the circular flow model by looking at those different measures of income, because there's a lot of looping activity that takes place in our economy. That is, when expenditures occur, those expenditures create income, and it creates a flow between the different sectors. When households, for example, have expenditures, it creates income for businesses. When businesses get income, for example, they have to pay taxes to the government. It's an expenditure. And so the circular flow model is simply tracing the flow of income and expenditures between the different sectors of the economy. But really, I think a good way to get a sense of the circular flow model is to be aware of the different measures of income, because once disposable income, for example, as I had in the earlier slide, once we calculate disposable income, this disposable income is used for two purposes: consumption expenditures and savings. And so the consumption that results from the disposable income then feeds back or flows back into the consumption for the next period. So it creates kind of a circularity. So you have consumption for the current period, determine disposable income. That disposable income feeds consumption for the next period, and so it creates a looping, it creates a circularity. So you can get a sense of the circular flow process by looking at these different measures of income. Last thing I want to mention very briefly is the connection between GDP and the underground economy. The GDP process is trying to identify the production of new goods and services during some time period. So it's trying to track quantities of goods and services to assess growth. Now, there's a lot of economic activity. Some economists estimate as much as 8% of economic activity occurs what we call underground. Underground is that it's not occurring where we can track the level of economic activity precisely. For example, a lot of illegal transactions, like drug trade, for example, it's not going to be something that you can easily detect on the surface, but those transactions do exist, and there are expenditures in those transactions, unfortunately, and there's income created in those transactions. And so GDP would tend to not assess those transactions initially because of their illegal nature. And so those type transactions tend to frustrate the GDP process. Another example, like there's a lot of bartering activity that takes place in our economy where people will swap goods for goods or services for services. You know, you cut my grass, I do your economics homework, something like that. So those transactions, they involve a lot of productive activity, and there are new goods and services being created. My lawn is being mowed, your economics homework is being done, and so there are goods being created, and those goods escape the GDP process because there isn't a reporting and there isn't a exchange of money income. So the point is, GDP tends to be a somewhat conservative assessment of growth because there are some economic activities that occur underground that escape the GDP process. So by escaping the GDP process, the numbers that we focus on representing growth tend to have a conservative element associated with them, because there is some productive activity that GDP simply cannot capture. Alright, so GDP tends to result in a somewhat conservative estimate of growth. Alright, so that takes care of the main points of the GDP chapter. I would say, spend some time with the homework to acquaint yourself with the concepts, play with the terminology, look at the exhibits, presented in class, look at the notes developed in class, and supplement it with this kind of refresher. Hopefully the combination of the three will result in your gaining mastery of the GDP process. GDP is how we measure growth or shrinkage in our economy. So until